Welcome back to Investing Talk Podcast.
Today we're looking at Lumentum.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Yep.
And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay.
For anyone who's been tracking this frantic build-out of AI infrastructure, the actual physical hardware.
Right, the wires, the lasers, all of it.
Exactly. Lumentum isn't just a component supplier anymore.
No, it feels like they've become a really critical part of that whole optical networking backbone.
That's it. So today our goal is to really unpack this. Is the, spectacular recent performance justified, or is it just, speculative hype?
That is the core question. Because when a company puts up numbers this good, you have to be a little suspicious.
You do.
They just released their Q1 fiscal 2026 results.
And they weren't just good.
No, they were a thunderous beat.
Absolutely. The top line was, breathtaking. Revenue hit $533.8 million.
Which, for context, is a massive jump. What was it, 58.4% year over year?
Yeah, compared to about $337 million last year. That's the kind of growth you see in a tiny startup, not a, mature infrastructure company.
And it wasn't just chasing revenue, right? You could see real leverage flowing down the income statement.
It really reinforces the story that they're capitalizing on this AI demand surge, the non-GAAP earnings per share.
Yeah.
It just crushed expectations.
You get $1.10.
Which, again, looking back, is a huge leap from the $1.18 they reported a year ago.
And it easily beat the consensus forecast, which was around, what, $1.03?
Yeah. So the market sees that and thinks, okay, this company has successfully pivoted. They're capturing the highest margin business out there right now.
Which is the internal plumbing for hyperscaler AI data centers.
Exactly.
But that leads directly to the big question, right? Sustainability. Are these Q1 numbers a one-off?
Like front-loaded demand, maybe?
Yeah. Did all the hyperscalers just place all their orders at once, or is this really a structural change we can count on?
Well, the company's forward guidance seems to answer that pretty emphatically.
It does, which is why the stock reacted the way it did.
It's projecting continued strength into Q2. Their guidance for revenue is somewhere between $630 million and $670 million.
So that's sequential growth of at least $100 million, even on the low end.
That's incredibly aggressive.
And they're backing it up with profit forecasts, too.
Yeah, the EPS is expected to be in the range of $1.30 to $1.50.
So they're not just signaling a one-time ramp. They're telling the market this is a multi-quarter growth cycle.
Driven by these, huge secular AI forces.
And that guidance is exactly why the analyst community reacted so positively. We're not talking about small upgrades here.
No, firms like Northland, Mizuho, Stifel, JP Morgan, they all raised their outlooks almost immediately.
And they were all saying the same thing.
Pretty much. Citing Lumentum's leadership in high-speed datacomms, they see the company as sitting at a technological bottleneck.
They're making parts that the hyperscalers just have to have.
Right, to upgrade their whole architecture for AI training and inference.
So it basically makes Lumentum indispensable.
Which brings us to their competitive moat. The why behind all this.
Yes, the technology.
Because the growth is very specific. It's not generic.
All right.
It's driven by really two key product lines. First, they're EML lasers.
Electro-absorption modulated lasers.
Right. Those are essential for high-speed connections inside these massive data center campuses.
They're the workhorses. But the even bigger deal, maybe, are the new 1.6 terabit transceivers.
That migration from 400G and 800G to 1.6T is, well, it's fundamental for any new AI cluster.
They're basically providing the tech that lets all these NVIDIA or AMD GPUs talk to each other without crippling latency.
I like the highway analogy. If the AI chip is a Ferrari, the transceivers are the lanes on the highway.
And without upgrading to 1.6T, the Ferraris are just stuck in traffic.
Exactly. Lumentum is building that new 16-lane superhighway.
And they're innovating beyond just the transceivers, too, right? With optical circuit switching.
Oh, yeah. There is huge anticipation around their R64 optical circuit switch.
This is the thing the market is really watching.
It's the true differentiator. What this switch does is it dramatically cuts power consumption and latency.
Which are the two biggest enemies in a data center.
For sure. Traditional switches burn a ton of power and add delays. The R64 uses LITE to reroute traffic instantly. For AI, where every millisecond and every watt matters, this is a game changer.
Okay, so the tech story is a slam dunk. The growth is phenomenal. But let's ground this in financial reality for a second.
This is where it gets a little more nuanced.
So on the liquidity side of things.
Surprisingly solid, actually.
Yeah.
Even with the huge ramp up and all the restructuring costs.
So even with all the capex needed for AI production, their liquidity is good. The quick ratio is what, 1.02? And current ratio is 1.37.
Yeah, they're not struggling to cover short-term liabilities. That's a huge plus. And they generated $57.9 million in cash from operations last quarter.
So the growth is turning into actual cash.
It is. However, the pressure point is definitely on the margins.
Right. The gross margin is okay, around 30.6%.
But you look further down, and the EBIT margin, earnings before interest and taxes, is still negative.
Negative 2.8%. That's the main operational risk here.
It is. It shows that even with this massive AI-fueled revenue jump, they've still got these lingering cost pressures.
And we know why that is. Scaling up production of these super specialized components is just incredibly expensive in the short term.
Right. It compresses margins until you hit economies of scale.
So the bet is that revenue growth will eventually just overwhelm those fixed costs and push EBIT into the positive.
But until that actually happens, the risk is there.
We should also touch on their debt.
The debt-to-equity ratio is around 2.77. It's moderate leverage. They're using it to fuel this growth cycle.
Which is pretty standard for a capital-intensive tech company.
But the number that really defines the whole story here is the valuation.
Oh, this is the wild part.
I mean, you have to pause here. The price-to-earnings ratio is just exceptionally high.
The calculations range from, 156 times earnings on one end?
All the way up to an outlier of over 223 times earnings.
From 156 to over 1,200. That's the definition of a high-stakes bet on the future.
And that massive gap is all about how you treat GAAP versus non-GAAP earnings and how fast you think they'll get to profitability at scale.
Paying even close to that means you're pricing in like a decade of perfect execution.
You're paying a massive premium for future success, which, calls for extreme caution.
And that success isn't just about tech, it's about internal execution, especially with all the restructuring they've been doing.
Right. If you look back at Q3, they had a GAAP net loss, but a non-GAAP net income.
And that difference is all these restructuring costs.
They're trying to get leaner, more focused on the AI opportunity.
We saw it with that $12.4 million in asset write-offs for site consolidation.
Which is painful short term. It hits your GAAP numbers, but it's designed to improve the long-term cost structure.
And they have the cash to do it.
That's the key. They have a huge buffer, about $866.7 million in cash and short-term investments.
So they have the flexibility to fund this cleanup and invest in new tech without needing to raise more capital.
Which is a very strong position to be in.
Okay, let's switch gears to the stock itself. The momentum has been just incredible.
A total rocket ship. You can tell it's capturing institutional attention in a big way.
Yeah, I mean, the stock was up 61.7% in the prior month alone.
That's not just a little outperformance. It absolutely crushed its peers. It tells you the market believes this is one of the purest ways to play the AI build-out.
And the technicals confirm it. You've got a clear pattern of higher highs and higher lows.
Trading well above the 50-day and 200-day moving averages. That's a classic bullish signal.
But the options market is signaling some caution, right? Volatility is very high.
Very high. Implied volatility is running somewhere from 45% up to almost 98%.
High risk, high potential reward.
Exactly. Shows a lot of uncertainty. Or maybe just expectation of more big price moves.
But what's interesting is that even with this massive rally, your classic momentum indicators like RSI,
they're not signaling that it's dramatically overbought. Not yet.
Which could mean there's still room for this to run.
If the company delivers on its catalysts. Which brings us to the why now.
Right. What do investors need to be watching over the next few months?
Number one is the next earnings release. Q2 expected in February. They have to keep this momentum going.
Another beat and raise is basically required at this valuation.
For sure. But it's also about product execution. The official market launch of that R64 optical circuit switch.
That's expected next quarter. If that gets confirmed traction with a major hyperscaler,
that would be a huge catalyst. It would validate the entire narrative.
And then you have the institutional flows to watch. 13 F filings are due in December.
We'll see exactly which big funds we're buying during this rally.
And then ETF and index rebalancing in January. If its market cap is up, passive funds will be forced to buy,
creating a nice, non-discretionary tailwind for the stock.
Then you have the more speculative stuff.
The market chatter. There are rumors of more hyperscaler supply deals in the works.
And the M&A talk never really goes away for a company this strategic.
No, they hold the keys to some of the fastest optical components. They're always a potential target.
I've seen some traders speculate that a new big contract could trigger a quick breakout above the $300 level.
It's possible.
Yeah.
But zooming out, the long-term story is just about the structural demand.
Exponential data growth, deeper penetration into the cloud, and just more and more complex AI workloads.
But as we've said, this whole story is not without its risks. The market has priced in near perfection here.
Absolutely. The top risk is still that negative EBIT margin. If they don't show consistent improvement there, the stock will get punished.
And there's execution risk. These are huge, complex contracts. Any delays or quality issues could stall everything.
And finally, just the sector valuation as a whole is very high.
Right. If there's any sign of a slowdown in AI spending from the big players, a stock with this high a valuation could face a very painful correction.
So, Lumentum is perfectly positioned in the hottest sector in technology right now, serving an indispensable role in the AI data center build-out.
The real question you have to answer as an investor is this. At what point does their technological dominance, with the EML lasers and the R64 switch, outweigh the huge risk you take on by paying this astronomical valuation? That pivot point is everything.
Make sure you subscribe so you don't miss our next analysis.